Welcome back. Today we're going to work on cost volume profit analysis and go over the concepts related to that topic. I'm going to share a PowerPoint with you and we're going to continue with our concepts. So in this class, we are jumping around a little bit between the chapters, but concepts do intertwine in each chapter meant to be present interdependently. So that should not change what we have learned so far or what we missed between the topics. However, some of the concepts we learned early on in the semester will be coming back and we're going to be revisiting again as we going through the topics. Okay, our first learning objective, we're going to try to explain how changes in activities affect contribution margin and net operating income. So we talked about contribution margin from net income perspective, and we did work on how to prepare them. So let's take a look again on the concept. The best way to do this particular topic, I would almost recommend to maybe pull out a notebook and actually write down the data, pause the video. This way, we're going to keep coming back to the same data set and changing the numbers to understand the cost behavior. And this would be able to help you to relate to information. So this whole topic will be presented throughout the example, obviously trying to understand some definitions. So what we have here, we have a racing bicycle company. So if you can see my mouse moving around, and contribution income statement is, you remember, we have variable expense minus fixed expense. This is not to mix with a GAAP income statement where we have sales minus cost of goods sold. So here we're dealing with a contribution margin, and contribution margin is amount remaining for sales revenue after variable expenses. So this is what is left to cover any other cost company might have. Okay, so direct material, direct labor, and any other variable expenses, it could be selling variable expense as well, would be in here. And everything that is fixed, as you remember from previous topic, fixed expense cannot be changed even if we're not producing any bicycles at all. We would have zero. The reason I like this example, it's very much Wisconsin kind of topic, because we have track here in Wisconsin who makes bikes, and Wisconsin actually produced quite a few bikes. So we can, and hopefully some of you guys are bikers out there can relate to that. So this information is presented to us. So now also we know it's 500 bikes, and we have $250,000 that we made. So if we take 250,000 divided by 500, you can figure out what we sell each bike at. Also, if you can take 150,000 divided by 500, you can figure out how much a variable cost per unit. So this gives us information beyond that. So we can definitely be extrapolating. But again, this data will be used over again as we're moving through this example. Okay. So I kind of mentioned this before. First, we're going to cover all the costs, and then we're going to be covering our fixed cost in a company. So if I take 250,000 divided by 500, we're going to have $500 per bike cost. So it's a nice bike. We all know the bikes can definitely cost much more than that. So, but it's a nice round number. This way we can get an example across it. Now, if you divide 150,000 by 500 again, you get a $300 per unit. So now we have a contribution margin per unit. So each bike we make, we have $200 left to cover fixed expenses. So we have to produce quite a few bikes, right, before we cover that $80,000. So this, just to kind of look forward to this chapter, we're going to talk about break-even analysis where we don't make any money. So right here, without even taking any further information in, you can take 80,000 divided by 200. You know how many bikes you have to produce before you can start making any money. So this is kind of interesting way of seeing this. And this would be used as we're moving through the information. So each month must generate at least 80,000 in total. I'm kind of repeating what I just said, but this is in the format of a PowerPoint. Contribution margin to even break even. So they need to cover 80,000. So each time they make a bike, so they make one bike, they have another $79,800 to cover. So it keeps going down as we're producing more. Now, if you take 80,000 divided by 200, you'll get 400. So 400 bicycles, this is where we break even. This is a good time to introduce what break even is. Break even when we have no money we made. Obviously, we had some sales, but we covered all our expenses. So this is the point where whatever you earn equals to your expenses. And even though we're looking at this from the business perspective, we do know that even at a household, right, as you're looking at your expenses, right, you say, okay, I need to at least break even. Can I have this expense versus this expense? So we do this all the time. It's like, at what point you break even? We obviously try not to spend more than we earn in order for us not to be in a negative. So obviously anything below 400, we're going to actually have a negative operating income, and everything above would actually be net operating income. So when I sell my 400 first bike, right, my net operating income is going to be $200. So after that, it's click, click, click. We have each bike we sell, 2 bikes, we have 400, 3 bikes, we have 600. So our income is going up once we break even, exactly by amount of contribution margin. So 400 first bike will generate that $200 income. So let's take a look what we can do with that information. We really don't need to prepare income statement, because remember, this is managerial accounting, because we need to be able to estimate to figure out particular sales volumes. All we have to do is look at our contribution margin per unit. So if we sell 430 bikes, its net operating income will be 6,000. All I did is I took anything above our break-even point times 200, and I can tell you what their net income would be. So it becomes a very powerful tool, and something can be used over and over again. Now, this looks a little bit, or hopefully a lot, familiar to you, um, because we talked about total cost, right? You guys remember that from the past. We said total cost equals fixed cost plus variable cost. Well, here we kind of extrapolating on the same concept, and we say your profit really sales minus variable expense minus fixed expense. So that's kind of formula that we're looking at. All it is our net income in a different format. If you really see it, sales minus variable cost minus fixed cost equals your final profit. And if we plug everything in, we can also look at it as a formula. So this kind of just abbreviations that is set up with the same concept. Now, you guys remember that sales, right? We took quantity sold, those 500 bikes, times 500, and we got total $250,000 sales. The same thing happened with variable cost. We took 300,000 $300 times 500 units, and that's my total variable cost. So all we did, we just broke this down into the variables. So now we can actually use this as a formula, and we can see how profit is calculated. In this case, profit net income is the same concept. So we can take this formula a little bit further, and we can actually start playing with that by saying, well, if profit equals price times quantity minus variable time cost times quantity minus fixed expense, therefore profit also equals unit contribution margin times quantity minus fixed expense. All we did, we actually extrapolated a Q here, right? And price minus variable cost is your contribution margin. So mathematically, that makes sense. So this is the same thing, just being written in equation format. So now you can use equation in order to calculate how much you will make by selling 401 bikes. So let's, in this particular chapter, we're not going to be doing graphing, but some students are more visual with graphs. So I kind of keep including this into the lecture portion to show you visually what really happens with a break-even analysis. So you're not required to prepare a graph, but I want to show you the graph for you to be able to understand how it works. So here we have the same information. We're going to work with the same bikes, and we have different activity, zero activity. Obviously, if we have nothing, we're not producing, plant is shut down. We have negative 80,000 loss because fixed costs still have to be covered. If we sell 200 units, we have negative 40,000. 400, as we learned just now, it's a break even. And if we have 600 bikes, or if you really think about it, we have, 100, 200, 100 above what 500 would be, and 200 above 400 break even. So 400 bikes minus 600 bikes, it gives you extra 200 bikes you made. 200 times your contribution margin of 200 gives us a 40,000 net operating income, or you can just run through the numbers. So we're going to plug this information, right? 0 bikes sold, 200 bikes sold, 400 bikes sold. This is our cost. This is our quantity. So this is our cost right here. All right. And sales figure, if we make no money at all, right? We don't sell anything. Obviously, we have a 0. This is our cost, and this is our fixed cost. We saw this before, right? It does not change. So anything here in this area before the break even is our loss. And you can see further or closer we get down to a break even point, less loss we have. And then boom, as soon as we sell this 400 first bike, it just expands, right? So after fixed costs, everything, and this is why we see, like, doing after Christmas time, a lot of times you have a lot of big sales going on. Sometimes you're like, oh my God, this is so cheap or reasonable, or how would they ever cover the cost? At that point, they most likely already recouped all their fixed costs, and all they care about, right, everything they sell right now, they just have to cover their variable cost, and they would be earning the money. So it's definitely a good way of visually view this. We would not be creating graphs, but if you're a visual person, you can see break-even point, loss area, and this is a profit area. Okay. We're going to move to learning objective 3 for this topic. We're going to use contribution margin ratio to compute changes in contribution margin and net operating income resulting from changes in sale volumes. So we looked at this already from a perspective of a formula of a quantity, but we're actually going to start looking at in a ratio situation. So contribution margin ratio, not contribution dollar value, but ratio, is contribution margin divided by sales. So our contribution margin was $80,000 divided by $200,000 sales. So in this case, for each dollar increase in sales, we would safely say our margin would increase by 40 cents. So this gives us a different sense how we're looking at our calculation. What does that mean for a problem? Well, for a problem is $200 contribution margin divided by selling price of 40% means when we actually increase our sales for each dollar, again, it's 40 cents. Now, variable expense ratio, we're saying what is relationship of variable cost to sales is 60, or you can take really 1 minus 40 and you get 60, but that's another way of doing it, 40% that we just calculated here. So we're saying for each dollar of sales, 60 cents goes towards the variable cost. That's another way of looking at this. And this is summarized right here. So 1%, which is 1%, 100%, which represents 1, minus 60 is 40%. So that's something I just summarized, another one. All right, so how would we apply the percentages? A 50,000 increase in sales revenue would result in 20,000 increase in contribution margin. So instead of doing this per unit, we can take 50,000 increase, right? 50,000, because we know 50,000 increase between 200 and 250. So 250 minus 200 is 50,000 times 40% of our contribution margin will result in $20,000 net increase. And we don't have to do the rest of the calculation. So this is very powerful tool when somebody, let's say we're going to do a marketing campaign for bikes, there's a new race coming up, we're going to travel, and due to this marketing campaign, our sales going to go up $70,000. So boom, right there, you say, well, what impact does it have on our bottom line? 70,000 increase times 40%, you will know what the increase for your marketing campaign would be. Now, the big thing is in the managerial accounting, and I have seen this in businesses a lot of decisions are made. However, once they're made, does the marketing campaign really increase the sales by 70,000? And then we're going to see some problems as you guys doing some of your practice. Somebody might have to spend additional money to do that marketing campaign. So just because the sales increase, some of your costs might go up. So you would be considering that as well into the final net income calculation. So relationship between profit and contribution margin can be expressed using the formula. And this is the same thing we just seen, it's just put in a different format. So the same thing we did before, we said 40% times 250, that gives you a contribution margin of 100,000 minus 80,000 equals profit of 20,000. So the difference when we use the percentages, you will get a dollar figure. What we calculate, so you would have a dollar figure right there in front of you. So this is another way of approaching your problems, and it doesn't matter which method you use. You do have to be careful when the question is asking you if for units break even or dollar break even. So some questions asking you different outcome. On learning objective 4, we're going to look at the effects of net operating income of changes variable cost, fixed costs, and selling price. So we just talked about change of a quantity, but other things could be changing as well. And this is going back to a marketing campaign example. So let's say RBC can increase unit sales from 500 to 540 by increasing the monthly advertising budget by 10,000. So we cannot just take 40 extra bikes times our sale price times 40% and say that's our final net income. We also have to take in consideration for that increase to happen, we have to also use $10,000. So obviously, whatever they make, right, need to cover that $10,000. And I'm sure some of you guys already know the answer. So because we make extra $200 per bike, right, 200 times extra 40 bikes, would not necessarily, it would only increase by $8,000. The cost would be $8,000, increase 8,000, but the cost is 10. So we actually, by making this campaign, would have net operating income decreasing by $2,000 if we do full income statement. But just to show, and I'm actually gonna do this quickly here. I just noticed you probably cannot necessarily see the letters on this one. And this is a live TV, so you guys get to see all of it. Here we go. You get to see me redoing this as well. We're back. So sale increases 20,000 will decrease income by 2,000. And just that box was kind of light. I mentioned it, but you couldn't see it. So contribution margin $200 per unit, 40 units. That's great. You just made extra 8,000, and that would be an awesome thing if it did not cost you anything for advertising. So if somebody wants to fly out and do this awesome race and promote the bikes, and they think the sales going to go up by 70,000, it would be awesome. Okay, let's say 70,000 units. You say, what is the cost of actually running the advertising campaign? So here we not just looking at a cost, we're analyzing the cost. So as one thing is to be able to calculate it, as another thing is to take a step further and see it from different direction. So what is a profit impact of RBC can use higher quality raw materials that increase variable cost per unit by $10? So let's say we want to put extra or material there that would make a bike more lighter. I think that's one thing bikers look for. So if that is happening, a variable cost, right, decreasing a contribution margin. So to generate an increase in unit sale from 500 to 580. So we're going to make bikes a little bit better, thinking it will attract additional customer. So if we do that, right, our variable expenses are going to go up because obviously it's $10 more, and obviously contribution margin is lower per unit. However, because of the volume of extra 80 bikes, we have increased right now from 20,000 to 30,200. So that's a really, really good decision. So we definitely should do this. Again, you want to make sure it costs us only $10 because I'm sure everybody have seen this in an organization. Somebody comes with a great idea. They think it's going to cost 10 and it costs $20. That's not how the information was used to make a final decision. Next thing you know, they might not be receiving correct output. Let's look at example 3. What if they cut selling price by $20 and increase advertising budget by $15,000? So they're running a promotion, and this would increase sales from 500 to 650 bikes. What impact would that have? In this case, a lot of work, but in the end, we're making extra $2,000. So 650 units times 480. Remember, we decreased the price by $20. And remember, we increased our fixed expense by 15. So sale would increase by 62 and overall net income increased by 2,000. And don't let those examples divert you that, oh my God, all this work, and then we have only $2,000 increase. It could be 2 million. We could put 3 more zeros after each of this and say, we can extrapolate the data much further. We're just using this as example to get a point across with the numbers that can be followed through. Let's look at another situation. Let's say we're going to pay $15 sales commission per bike. And remember, if it's per bike, per unit, that's a variable cost. So a variable cost just increased by $15. Instead of paying salesperson flat salaries that currently is $6,000. So we have taken away $6,000 fixed cost and increased by $15 variable cost. So we have increased unit sales from 500 to 575, and overall, it's going to have a positive impact. Nice thing about this during recession, you don't have to cover fixed expenses. So variable cost really increases and can be more easily adjusted during the recession time. There's less fixed costs to cover. So again, this would be a positive change because after we're done, your net income have went up. We're going to take this to example 5 and look further. So to sell 150 bikes to a wholesaler without distributing sales to the other customer or fixed expenses, what is the price accord the wholesaler if they want to increase monthly profit by 3,000? So now we are looking at profit planning. This is start going into that category. So we want to have 3,000 profit and we're going to sell 150 bikes. So it means all we want to do is make only $20 per bike. And our variable cost per bike is 300. So all we do, we're assuming with full capacity, we don't have to worry about it. Anything else. So the selling price required would be 320 per bike. So remember 500, right, was our original price, but we're willing to let them go at 320. So all we did is just added what we want to make above our variable cost. So determine break-even point. You already saw it on the chart, but now we're going to do it in a calculation format. And we already discussed that 40% of contribution margin is what we have 40 cents left after each dollar of sale, and our variable cost is 60% or 6 cents for each dollar of sale. So profit equals unit contribution margin times quantity minus fixed expense. So this is we call equation method. And we use this as a part of a basic profit equation. So we knew profit was something that we have left over, but at break even, by definition, my total cost, which is fixed and variable, equals 0. So because break even point is 0, we're going to set our equation for 0. And again, we put it in a format. We have done this before, but now we're doing more in equation format. So the equation method will calculate, and this is important to mention, in units. So equation method will derive into units. So when we use this formula, unit contribution margin per dollar figure times quantity, and solve for the Q, we get the units. Now, if we want to do it in dollars, we will be talking about this in a little bit. You can obviously take 400 and times your contribution margin to figure out the rest, or 400 units times 500 to figure out what the break-even point sales figure. But you definitely this is a good starting point. So equation method per unit. So formula method is a shortcut version of the equation method. So this is important to kind of understand. The center on the ideal discussed earlier in the chapter, that each unit sold provides certain amount of contribution margin. And I think some students do actually like to see it per unit. So suppose RBC wants to compute the sales dollar required break-even on a target profit of $0, and we're going to use the equation method and the formula method to solve the problem. So now we're switching things around. So we're using right now equation method to do the percentage. So 40% times sales. So now our break-even point comes up in the dollar figure. So we're working within the dollar figure. So our answer has $1 associated with that. So this is equation method. You get the dollar. So if the question is asking you what dollar they break even at, you're going to use the equation method. And if the problem would be asking us what is our units, you're going to be using a formula method. And I know they kind of sound similar, but that's how this I want to use the same vocabulary than your homework would look like. All right. So dollar break-even point sales, you can do your fixed cost divided by your percentages, and you get your $200,000. Okay, now we can plan for target profit. So we plan for break-even, that's 0. But what if you want to make some money? So suppose RBC management wants to know how many bikes they want to sell to get a target profit of $100,000. So instead of 0, what we did for break even, we're going to here plug in 100,000. We know our unit contribution margin of 200 times Q. It's unknown because we're trying to figure out quantity of units. Okay, and we're using equation method here. Minus 80,000 of fixed cost. So mathematically work it out. You're going to move your Q on this side. You're going to move your dollar figure on this side. So once you do your math, 180 divided by 200 equals 900 units. So we just planned the profit. So somebody kind of working backwards. I need to increase my bottom line by 20% this year. How do we do this? We can work backwards and say that we need to sell 900 units. So this is very critical to make sure that we understand how to start applying this. This is not just calculating final results. We are doing some planning. Now, for formula method, we're going to take target profit plus fixed expenses divided by contribution margin per unit. So we're going to be dividing that. So 100,000 plus 80,000 divided by 200, you get yourself 900 units. So you're trying to make enough money to cover your fixed expense as well as additional profit. What if the question asks for sales dollars? So we're going to use a formula method. And for that, we're going to use contribution margin ratio. So when question is asking you sales volume or sales dollars, you're going to use percentage. And this is when we're going to apply equation method, not the formula method. And you're going to get yourself 450. Now you say, well, could I have done it differently? Could I have taken 900 times $500 per bike? I already knew the answer. Yes, you could. But this way you can just go directly. And there's some problems you'll just have a percentage available to you. So then you can use the equation method to get where you need to be. And this is also formula method for the sales dollar solution, 450. So you covering 40 cents you have really left after each sale to cover your 180,000, which includes fixed cost and planned profit. Let's talk about margin of safety. I like to call it, it's not exactly maybe accounting term, but a buffer zone in this case. So companies want to make sure everything is estimated, that they do make enough money that they're not in a red or they don't drop below a certain level of sales that I want to um, not meet to keep their stakeholders, which could be shareholders, creditors, customers, happy. So margin of safety is the excess of what budgeted for actual sales dollars. So something over break-even point. So it's similar to how you would be planning the profit, but you might be creating that additional volume that you want to make sure that you don't go below the red line. It's amount by which sales can drop before losses occur. The higher the margin of safety, the lower the risk not breaking even point occurring or even loss. So they want to make sure they have that. And that could be used to set sale price too. You might be increasing your sale price as long as you're not losing any customers. So we're going to look at RBC and determine margin for safety for them. Because we started our problem with 500 units and we determined 400 units is our break-even point, their margin of safety is 100 units or additional $50,000 in sales. So it's another way of looking and say, well, that's really their net income extra 20,000, but we're talking about margin of safety in sales figure. So if somebody says, what is your percentage of margin of safety? We're going to take what is excess over where we break even divided by actual sales that we're planning to have. So in this case, it's 20%. So company might have a policy what they expect to have. And in units, it's 50,000 extra dollars divided by $500 sale price per bike. In this case, we have 100 bikes is margin of safety in a units presentation. Towards the end of this topic, we're going to talk a little about cost structure and profitability stability. I kind of alluded to this earlier in the lecture, the infrastructure of a company, how much they wrap up in variable cost versus fixed cost can very much determine how company would do during recession or in an upstream. So the companies that have a fixed cost might find themselves in a tougher position during the recession because they cannot adjust their cost as fast. So as we have seen with the bikes, when we moved commission cost to variable cost by giving salespeople commission based on volume, right there, it changed the behavior of the company leverage. So cost structure referred to relative proportion of fixed and variable costs in an organization, and managers often have some latitude in determining their organizational cost structure by just tweaking if they may be renting versus owning the building. So if you're renting, maybe you can get out of the lease if we cannot no longer participate in economy. So those things are critical as the structure works. So advantage of a high fixed cost structure, that income will be higher in the good years because you are most likely, if you own the property, if you have costs that you cover, once you cover them, more you make, every dollar goes up. Because think about it, once you cover that $80,000, everything goes towards your bottom line. Now, when you have higher well, we'll talk about variable costs in a second. Disadvantage of high fixed costs that when we have a bad years, right, the cost is still there. Company with low fixed cost structure enjoy greater stability in income across good and bad years. So there's definitely more less fluctuation going on there. But for variable costs, before I go to the leverage, what happens is that higher variable costs in the good years, right? Now you have to pay that extra $15 per bike to a salesperson. Suddenly it's keep absorbing your profit is your cost going up. So we're going to and a final objective here, compute the degree of operating leverage. And I like to think of it as like titty-totter, if you're seeing my video. As a kid, I don't know, I don't see them on playgrounds as much anymore. They're fun. And particular sales to explain how it can be used to predict changes in net operating income. So we have a degree of operating leverage measures how sensitive net operating income, right? Because we remember the longer the board, the higher the seam, the higher the titty-totter goes. It is a measure of any given level of sales, of how a percentage change in sales volume will affect the profit. So all we're going to do, we already have calculated all of this. We know our contribution margin will divide it by net operating income. But in this case, we know a degree of operating leverage. So going back to our buy company, RBC, their degree of operating leverage, we take their contribution margin, $100,000 divided by a net income of 20 is 5, okay? And the big thing is, I have students ask me, what is a good operating leverage? And I would say depends on the company. So you're looking at something that is company industry average. That's the best way, a best indicator to understand it. So manufacturing might have a certain type of manufacturing, one degree of operating leverage versus merchandise company, different one. International operations might have a different degree of operating leverage. So this number is very much more industry driven. Okay. What can we do with that? Well, quite a few things. So let's say RBC is increased sales by 10%, while with the operating leverage of 5%, and remember, operating leverage is where your fixed costs and variable costs, how they distribute it among each other, will actually increase your profit, the bottom line, by 50%. So if we do this, if we do the calculation, and 50% of 20,000 is 10,000. So it went from 20,000 and increased by 10,000, which is 50%. And that gives you another way of calculating your net income or understanding what impact economy can do. And you guys can run through the numbers. And this is not what we need here. Structuring sales and commission. So company generally compensates salesperson by paying them either a commission based on sales or salary, plus sales commission based on sale dollars can lead to a lower profit in the company. So let's look at example. We're going to look at two types of surfboards. The XR7 and Turbo, and XR7 sells for $100 and generates contribution margin of 25. Turbo sells $150 and earns contribution margin per unit of $18. So the sales force and Pipeline Ultimate is compensated based on sales commission. So they are compensated based on sales commission. If you are on the sales force at the pipeline, you would push harder to sell the Turbo, right? So let's go back and look at the numbers. So the sales for 100, right? And contribution margin per unit is 25. And we have 150 and earns contribution margin of $18. So obviously, if you're getting compensated, you want to have a higher number. Again, if you are Salesforce, if you want to put a harder Turbo, even though XR7 earns higher contribution margin per unit, because you're getting paid based on the dollar figure. So to limit, and this is more like HR question, if you want to get rid of type of conflict, commissions can be based on contribution margin rather than selling price alone. And a lot of times, actually, commission I paid in a higher dollar figure. So 150, that's what I want to sell, right? But that's not where I'm making my money. You want to sell those. If you think about it, if I sell 2 of those as a company, it would be $200, and my contribution margin is $50 going towards covering my fixed cost. If I sell 2 turbo, it's 300, but I only have $36, right, going towards my bottom line. So definitely XR7 is more profitable for us. So from HR perspective, you would want to build maybe a different structure if that's the case. Now, I did say it was final one, but it's not the other one. We also have a multi-product concept. So we just dealt with one bike before. What happens if the company have multiple products? How do we approach this? So whatever we did with one product, we're going to extrapolate and we're going to assume the mix is the same. So there's a couple things we have to apply. I'm going to kind of go one by one. So sales mix is relative proportion to which the company product are sold. So if I look at a Starbucks, right, you say on average we sell 50% just regular coffee, 25% mixed ice drinks, and 25% hot drinks like cappuccinos, macchiatos, all this other stuff. So they have a mix, right? So if they know their mix, they can actually do this type of calculation. Obviously, you're making some assumptions. Different products have different selling price, cost structure, and contribution margin, so they're all combined together. When company sells more than one product, break-even analysis become more complex, and we're going to look at a bikes example to see how to calculate that. So in this case, we have a bicycle and cart, and we've been just looking at bicycles, but now we have carts also. So we have $300,000 of carts, variable cost of $135,000, and contribution margin of $165,000. So at this point, if we look at overall, you can see the relationship here. Bicycle, the sales cost is 100%, 60% goes towards variable cost, and what is left over is 40% contribution margin. Carts has a different mix here, right? A different calculation. So we have sales at 100,000, variable expense is 45. So now our variable expense is a little bit lower here, and contribution margin is at 55%. So with that mix, if we look at a company total altogether, I took 250 plus 300 equals to 550. Our average contribution margin, 48.2. Mistake you do not want to make. You don't want to take 40 plus 55 divided by 2, because the volume is different of sales between two. So when we do this, what we're going to do, we're going to calculate our break even using our total, and then go back and break it between bicycle and cart. How do we do that? Well, my sales mix consists of $550,000. If I take 250 divided by 550, it's 45% sales driven from bicycles. And if I take 300 divided by 550, I get 55% is driven from carts. So again, just to revisit this calculation is familiar to us. We did the same thing for the carts. Then we combine two together to get a total. We're going to use this total to calculate a break-even analysis and go back and extrapolate that data using the percentages based how much it's in total in each bucket. Okay? So we know our formula, fixed expense divided by contribution margin of 48.2%. So for us to break even with this product mix, we need $352,697 in sale. We know this as a whole, right? But we do have two products. So what do we do for that? We take this number, right, and go back to our percentages. So we take 352,697 times 45%. So for us to achieve break-even points, we have to sell $158,714 worth of bicycles, and we also have to sell 193,983 cards. So all you're taking is your new break-even point times the percentage. For this particular problem, this is your example. I'm not going to do one in Excel for this chapter. I would highly recommend maybe either rewind it, get a notebook, as I mentioned earlier, rewrite this and make sure you can back into this calculation before you approach some homework practice problems. So this is a great example how to do multi-break point analysis. And this concludes a chapter. I'm going to stop sharing here for a second and go back to our video. Hi. And I just want to mention that take your time. There's a lot of things in this chapter, and make sure you kind of look at each thing separately. So we have formulas, we have contribution margin we're already familiar with. We have a break-even analysis here. We have a multi-product. We talked about leverage. We talked about profit planning, margin of safety. So there's break them down. They're all interrelated. We're all looking at the same cost. And if you understand this lecture part, you can do any other problem. So you just kind of have your template that you can apply over and over again. Good luck, and let me know if you have any questions.